Welcome back to Market on Close. I'm Caroline Woods in for Oliver Rennick. The Trump administration, according to reports, is indicating or planning to cut defense spending by 8% annually. What does that mean for defense stocks? Let's bring in Tony Bancroft, portfolio manager at Gabelli Commercial Aerospace and Defense ETF. Tony, thanks for joining the show.
Great to be here, Caroline. Thanks.
All right, so the big question is, what does it mean for stocks? We certainly know what it means for Palantir, because Palantir has been really selling off pretty sharply on these reports. I know you have some picks in the space in terms of, that you like, and Palantir wasn't one of them. But I am curious, when you look at a reaction like Palantir, do you think that's driven just by how high it's already run, or do you think that Palantir is specifically vulnerable to potential budget cuts?
I think Palantir is a great company. I think they're going to do extremely well. Obviously, it's run up immensely over the last couple of years here. So there's probably some people taking profits, but they've got some great programs. They're great operators. I think you're going to see a lot of good things coming out of them in the future. But we look more at sort of the core defense suppliers to these major weapons programs. And I know there's been a lot of there obviously has been a lot of speculation and a lot of talk in Washington and on Wall Street about defense cuts. But I think if you actually break it down, I don't see on frontline programs which our country relies on every day to defend our country. I don't think we're going to see large cuts there. I think, if anything, the administration is actually a defense hawk and looking to grow the defense budget. You've heard Vice President Vance talk about the U.S. needing to spend more on defense. You've heard President Trump recently calling NATO to spend 5% of GDP rate, along with other NATO members, including the Secretary of NATO, as well as Secretary of Defense and other bipartisan congressional members. So I think, we're actually, historically, the U.S. were relatively underspending relative to our post-World War II average of about 6% of GDP. We're about a little over 3% now. The U.S. needs to replenish stockpiles. We've essentially expended a third of our certain weapons of our stockpiles that have gone to Ukraine. Ukraine expended essentially 7 years of production in certain weapon systems, the Javelin and the Stinger missile in the first year of the war. And, if anything, there will be some adjustment. There's no question about that. They're going to probably look through, the DOJ is going to look through and figure out what needs to be spent. There are obviously some other long-term legacy programs that probably aren't in the future of how we're going to pivot to the Pacific, and those will probably go away. But we have some names that we like in our Gabelli GCAD Commercial Aerospace and Defense ETF, such as Textron, Ducommun, Curtiss-Wright, and L3 Harris, which are all going to play in which the Department of Defense, those 17 excluded areas, missile defense, subs, ships, areas like that where technology is going to be demanded in the future.
Okay, so just tell us quickly why you like those names versus some of the others where minds might go in terms of defense stocks, maybe a Raytheon or RTX or a Lockheed Martin.
Sure. Yeah. So obviously, we like companies that have high barriers to entry and sole source suppliers, which all of these are. For example, Textron, they sort of have two businesses. They have a defense business and they have a business jet business, which obviously the largest supplier, one of the largest suppliers of private air. But on the defense side, they have a company called Bell, which was just recently awarded a program to replace the Black Hawk. There's about 4,000 of the Army and other services Black Hawk helicopters in the U.S. and around the world. And it's going to be the next biggest aerospace defense program after the F-35. And as we pivot to the Pacific, you're going to need to have longer legs, and this is what essentially the system that they have is called the V-280. It's the FLRAA program, which essentially it's a tilt rotor aircraft and can essentially go longer ranges, just like a fixed wing aircraft, but also can land vertically like a helicopter. So you have programs like that they're on, and they also do the thermal protection for nuclear weapons, which the U.S. has talked about, the modernization of the nuclear triad. So they're well positioned. We like a company called Curtiss-Wright. They make out of Charlotte, North Carolina. They make a lot of the systems that go on naval nuclear reactors. So anything to do with subs or aircraft carriers, they're an integral part of that, and they're going to do very well. They also have a commercial reactor business, and obviously that business is doing very well as we're starting to see the small modular reactor business take off and having to extend the life of some of these reactors in the U.S. and worldwide. We also like a company called L3Harris. They actually acquired another company we owned, Aerojet Rocketdyne, which makes propulsion. Essentially, it's a duopoly. There's Aerojet Rocketdyne and then Northrop Grumman, which used to be Orbital ATK before they were purchased by Northrop. And they're essentially the two suppliers for propulsion. It's 30% of the economics of a weapon system, and they're critical. There's nobody else that really can do it at scale like they can, and they're gonna do pretty well. And then lastly, we have a company called Ducommun, a small company out of Southern California, which, yeah.
Tony, we have to leave it there. We're out of time, but we really do appreciate your insights on the space and your picks. Thank you so much for those. Tony Bancroft, Portfolio Manager, Gabelli Commercial Aerospace and Defense ETF.